Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Well, good day, everyone. It's Liam Garman here, editor of Smart Property Investment, in the studio today with the one and only Sam Gordon from Australian Property Scout. And was it principal of School of Property? What do you call yourself, headmaster?
I think I'm just director of everything.
The director.
Yeah, I just stay as that, man. I don't try and talk up any crazy titles.
Man, how is School of Property going?
School of Property's great, man.
Yeah.
Dude, it's been awesome. We were just literally talking about a second ago off there, the boot camp, which is coming up in November, man. Sold that out in 4 days.
Yeah.
So that's wild, man. So many APS clients getting behind it as well, and I do the monthly webinars within it as well. So normally sit there for about 2-3 hours and punch out all the answers to the students as well, man. So it's awesome, man. I love it.
Do you think, like, for there's a lot of people that listen to this podcast from, way back when, and they
sure.
know the ins and outs, or they think they know the ins and outs of smart property investing. What are some of the areas that you touch on that might even come as a shock to someone that has got quite a big portfolio and think they know something about property investing?
Well, man, I think let's break it down to people who've been listening to smart property investment for, let's say, 5 or 10 years. And then you might break it down to, okay, well, what's the definition of a big portfolio? Because realistically, if you've been investing for, let's say, 5+ years, you should at least have a 10+ property portfolio to be considered, in my opinion, a big investor that's gained a lot of knowledge and become an experienced investor that's built a portfolio. If you haven't done that, man, then there are definitely gaps in the knowledge that has been missed, and you should be a fair way along your journey in that regard as well. So there's a simple fact, man, that like most experts with things that are more insider knowledge sort of style of things that are, especially things you've got to be a little bit careful of talking openly about as well, going into the advice spectrum of the field. Man, there's things in there that like I openly won't talk about on a podcast because I can't have my disclaimers and whatnot on top of this sort of stuff as well. So there's things, man, I keep behind closed doors as well, that either I'll work on closely with mentoring clients, APS clients, and then obviously School of Property students as well. So things, man, like creative lending and really how we build out and scale portfolios. I personally built on less than $100,000 PAYG income before I ever ran my own business. A 30 property portfolio on a sub $100,000 PAYG income, right? So you need to understand how to really work the game from a lending perspective with that. So it's what we call creative lending, understanding that, understanding everything that goes alongside that as well. And there's I know how to use different things in property to get the lending. There's a difference between knowing how to do it and properly knowing how to do it and scale properly. If you've been in the game for 5 years and know what you're doing, you should have a 10+ property portfolio to show. So that's kind of really, man, and always it's strategy dependent, but effectively, man, that's where most people should be at, right? Creative lending is probably the biggest piece that comes into it. SMSF, man, so self-managed super fund, something that's become very big in the investing game these days. But in my opinion, man, 99% of the market gets it wrong. There's a way to be, in again, my humble opinion, a way to be very aggressive in building an SMSF and actually getting the net result that you really want by the time you get to retirement. Not just buying a deal or buying one commercial asset or whatever it is. It's how do I get the biggest and best result out of something that I may not have access to for the next 15, 20, 30, 40 years, depending on how old you are right now. So it's understanding how to scale that properly and stay within the regulations so you're not breaking any rules within it as well, which is intricate, but man, is so worth it because of the tax environment and vehicle that the SMSF is, that by the time you get to 60 as a minimum or 65, whatever, you could have a ridiculous passive income source on the side that you just build on the side as you go through. So man, they're probably two of the main key things. There's a lot of things around accounting, structuring, advanced strategies, how to actually build your own strategic plan to build and scale your own portfolio as well, and everything else in between, man. One of my favorite lessons in there is how to use property to buy a supercar. I love that one, man.
You know a thing or two.
I know a couple of things about that, man. And man, it's just little things like, and everyone's definition of a supercar, it is what it is, but it's being able to buy those really tangible assets that you might have your heart set on for your entire life, how to actually use property to acquire those assets as well.
Well, that's the goal, and something that you and I have spoken about a lot. I know one of the big hooks of APS is that 150 grand a year passive income. That's a goal.
For sure.
And when you have that goal setting and work backwards, then you can buy the cool car. In terms of the creative lending, well, actually, I'm going to quickly pivot from that. We do have a very cool podcast today. The theme is 5 critical mistakes that Sam Gordon saw from investors in 2025, with a bonus. I think it gets to 6 critical mistakes. We'll be touching on that throughout the podcast. But in terms of the creative lending, Is that to mean like trust accounts and lending through trusts? That's something that I see. I speak to a lot of property investors every single day.
Yeah.
And even people that have done a pretty good job with it. And there are some areas there where I'm like, you really don't know anything about using a trust account. Not trust account, sorry.
Yeah.
Through
Structuring,
buying it
structuring properly.
through a trust. Oh
Yeah,
gosh,
yeah.
I mean, talking to too many real estate agents as well. Through trust structures rather. And you're like, well, genuinely, like you really don't know much about this. Is that what we're talking about with the creative lending, or are there other aspects to it as well?
Yeah, man. I mean, there's a mix, man. So like everyone's situation is different. And that's where it really comes into understanding where you are intrinsically and what was going to benefit you the most. And different people will be starting in a different position. So yes, trust structures definitely come into the equation, but a lot of people also don't understand that. So they might hear trust structures. They go, yes, sweet, no worries. But it's nowhere near as simple and straightforward as that,
for sure.
Especially in terms of building and scaling a portfolio. So yes, they have their place, but also buying directly in your direct name may have a place as well. And it's really understanding, especially with where you're at and what's going to be the best vehicle for you. And then, yeah, man, having someone that understands it intrinsically irrelevant to your situation. And there's a couple of the points that we go in here. We'll actually touch on that today of the critical mistakes I've seen this year in particular. Yeah, man, people in the industry, that you would think know what they're talking about and know what they're doing. They just literally don't. And I'm talking brokers, accountants, people that should have real understanding around this. Mate, the vast majority of them have no clue how to do this thing properly. Yeah.
It is mind-blowing. You talk to people that, they're meant to be in the know, but they don't. So great to see that you're talking about that on School of Property. And big news, you bought a new place. A big one.
I did.
I've heard about this. I heard about this from like 4 or 5 people. And it shows that, Sam, you're like the flame, moths to a flame for gossip, because I've had about 4 or 5 people say you bought a nice new pad in the GC.
I did, man. I did.
Yeah.
There was a lot of people trying to call me out on it. I was like, oh, aren't you supposed to be a rentvester and all the rest of it? And I'm like, yeah, man. So I owned my own home for about 7-8 years. I lived in a primary residence, bought my first home at 19. Moved down to that.
Was it the Wollongong?
Yeah, it was, man. It was, in the Gong little unit.
Yeah.
That was the first place. And I owned my own home, lived in my own home until I was 27. And then I swapped to being a rentvestor. And I was a rentvestor for 8 years, man. And then bought the primary residence at 35. So I got myself into a position to be able to buy effectively the dream home at a 50% LVR, man, and effectively scaled the portfolio. And it was really interesting because I was about to go through a big sell down, a big liquidation. I was already in the process of going through a big liquidation of around about 15 to 20 of my properties I had earmarked that I was going to direct that capital, that profit into a large commercial asset. And man, I kind of just like pivoted, and when I saw this home, and then I bought it with a longer settlement on it as well, and so I took it from 15 to 20, and I upped it to about 25 to 30 assets that I was going to sell down and liquidate. And man, it just changed, and the direction changed within it. And I was never looking for a primary residence. That's a funny thing. And then yeah, man, the right house came along. I'm in it now. I love it. And yeah, man, I think the cool thing is it's what it's all for as well.
Yeah.
Because my co-host on Scouting Australia, Jimmy, so we went. It's a crazy. One of the craziest stories you could probably imagine. Like this is a very expensive home, and man, I literally viewed it within 24 hours before the auction. So we were sitting there. We recorded a podcast. I was there with Brendo, who's head of education at School of Property. Jimmy, who's my co-host at Australian Property Scouting.
Jimmy Ibrahim.
Yeah, man,
good man.
Big Jimmy boy. He's a champion. And Kelly, who's my EA and producer of the potty. And we finished the pod, and then one of the boys in the team sent me this deal to vet, and I was looking at it in between episodes. Recordings, and I opened my phone to check. I was checking rentals in the area, just have a quick squiz on rentals. I wanted to check something, and it popped up as my the last saved item that I had in there, and I clicked on the home and looked up. And when I looked up, so I looked at the time. I was like, oh, what time is it? Just for whatever reason, I looked at the time. And it was 1234. Right, so 12:34. It had this weird thing about 1234, and whenever I see it, people have like their lucky numbers or angel numbers, whatever they're called.
Yeah,
I saw it, man, and I was just like. Scrolled down, and about 10 people had sent me this home, right, in the month before. And I scrolled down and saw who the agent was.
Yeah.
And the agent's a client of mine.
Yeah.
And so I was like, oh, and I was like, and I showed the guys.
Coming together.
Man,
yeah.
and so I called him, and I go, mate, what's, can we come around and have a look at this house at some point? And he goes, well, man, it's going to auction tomorrow. I goes, auction tomorrow? He's like, yeah. And he goes, I'm going there at 4 o'clock Savo if you want to come have a look.
Yeah.
So we went and looked at it at 4 o'clock. And we rocked up, and then so I went home with Jimmy and Kel that night. Brendo lives in northern New South Wales, so he went home. Kel and Jimmy was saying me. Kel lives suburb over. And we're running through the properties I was already going to sell down, running through the estimated sort of net cash position I was going to get in. And then I worked out, I was like, okay, sweet. So to get to a 50% LVR or less, then I started calculating the other assets that I'd get in there. And I was like, I called the agent again. This was about 10 o'clock at night. And I go, man, like, it would be sweet to put a 90-day settlement on. He goes, yeah, man, whatever. Like, whatever you need on it. Yeah. So I had 3 months.
I suppose when you're at that level,
yeah,
right?
it's like, as long as they get the money that they're wanting. And he goes, yeah, that's fine, man. I'll be able to get that through. Because I explained why, and he goes, yeah, and that makes sense. I know what you're doing. And so then we ran through it, and I was like, okay, sweet. So I've got this amount of deals to take to market in the next like 2 to 4 weeks, get them sold down. And I said, I realized I would have stamp duty paid and be at a sub 50% LVR, which is what I wanted if I was going to do it. And so I had my ceiling, man. I walked in, and then we bought bought the house at auction.
Yeah,
so,
nice. Congratulations.
Yeah, no, thanks, man. But it was just funny because like everyone, like the story came out after, and I said like I didn't want my name in the news or papers or whatever. Yeah. And it was just like this crazy thing. This guy had seen the house less than 24 hours before and then bought it at auction.
Oh, so you actually...
yeah, but I had all my stuff kept out of it, so it was man,
now
it was
it's out there. Now, we won't say the location. I think I had about 3 or 4 people say, "Oh, did you see Sam Gordon?" But
it's cool, man, because it just to round that out is it's like. Man, I rent vested for a very long time, and I could have bought a primary residence many, many years earlier. But rent vesting was a strategy that allowed me to scale my portfolio to the size it was. And for full disclosure, I think at the time of acquisition of the primary residence, I had like 134 property portfolio, right? So very, very large portfolio. And rent vesting was a strategy that enabled me to get there because it retained so much serviceability and so much capital, because there's so much capital that goes into an asset of that size. And so yeah, man, it was a really nice little bookmark to the story of that rent vesting was to build acquire that asset.
That's the goal, right? To have that financial flexibility to be able to do things like
sure.
that. I don't necessarily think it's hypocrisy that you bought a PPOR because in the end, you and I have done so many podcasts. It's about not having lazy equity. If you've got an apartment in Sydney and it's going up at 1% a year, that's lazy. Put it elsewhere.
For sure.
There are better ways that you can grow your money. The serviceability aspect of it. If you're going to hamstring yourself, if you're going to have a ball and chain on your ability to service mortgages. Well, it's those aspects of it. You've said to me throughout so many podcasts, it's like you see that 1, 2, 3 investment property hurdle, and then people suddenly are, oh, I've kind of seen maybe a house that I can live with and settle with. And then they end up selling everything for a house that I'm okay with this for 20, 30 years. Not, mate, this is my dream. And I don't think many people would say, oh, if it's your dream, then don't do it. You did have your dream. So you did follow the goal to the end.
One of the crazy things, again, just to round out the topic of the primary residence is, man, it was 15, I've been investing for nearly 16 years now. You know what I mean? So it's like, it's a delayed gratification to get what you ultimately want. And I think this is one of the things, man, it formulated in as part of the strategy. It's the same as the cars, man. So I don't buy the cars with debt, right? So I sell properties off when I can afford to buy something like that. Depreciating asset, I'll only ever buy it with cash. And so, man, that formulates part of my strategy. Same as a primary residence, it formulated part of the strategy in terms of where I got to anyway. So, man, it's the crazy thing is as well, the longer you stick at this and the more that this snowballs, the bigger your dream home and the bigger your goals will get, because the closer that it actually is because of the work you've put in and that bit of sacrifice. And the sacrifice almost becomes, you almost wear it as a badge of honor, because you're almost like, yeah, sweet, okay, I might not own the primary residence, but renting in the same area or a better house in a better area actually costs me less than your mortgage. And I get to rent a better asset and have more serviceability to actually be able to invest harder. So it just makes so much more sense on so many levels until you can actually afford to buy that dream primary residence.
Yeah, for sure. And I think that's very reasonable. And then this ties in exactly into the theme of the podcast today. 5+ bonus mistakes that you saw investors make in 2025.
There's your bonus mistake number 7, mate. We'll throw in the bonus mistake number 2, number 7 is rent vesting.
So, as in not rent vesting is
100%.
100%.
If you're not in your dream primary residence, you shouldn't own it. It's as simple as that. If you're not in your dream primary residence, you shouldn't own it if investing is your goal.
Okay, can I throw a spanner in the works here?
Go for it.
What if, we've seen some areas have huge increases in property prices over the last few years. What if your rent is for your PPOR more or less the same as what your mortgage repayments on your PPOR are more or less the same as rent in the area.
I can guarantee you, even if they're around about the same, and they would only be the same if you're in more working class sort of areas. So the more expensive you go, the more blue chip you go, which ultimately most of us ultimately aspire to live in those areas. So I take like the house I lived in the GC, for example, before I bought the prime residence, $5 million home, rents for $2,000 a week. I can guarantee you there's about $150,000 a year in difference between mortgage repayments and rent.
Yeah, for sure.
But even if you come back to the more blue collar areas, and I don't say any sort of disrespect, that's what I grew up in. But let's say, $750,000 to $1.5 million, which these days is blue collar in most capital cities. In those areas, even if it was like for like, which it wouldn't be, principal and interest repayments versus rent, it wouldn't be the same. But even if it was, if you understand creative lending and you understand how to stretch your borrowing capacity and manipulate your borrowing capacity in the correct way, I can guarantee you, even if the repayments are the same, rent versus mortgage repayments, you can acquire so much more debt to acquire so much more property. So a $1.5 million primary residence undoubtedly also isn't going to be in the best growth location in Australia if it's where you want to live. You could multiply that potentially into $3, $4, $5 million worth of debt or asset value somewhere else. It's a considerably better location to invest in. So it's a no-brainer. And until you can buy that dream primary residence, it just doesn't make sense. It's people just doing it for the security of it. But in reality, what is actually going to get you closer to genuine security of, let's say, the dream primary residence with no debt or very little debt level?
And then you also had the added benefits of the diversification argument that if you do have multiple assets across multiple cities, you diversify. I mean, if you turn the clock back 4 years ago and you bought an investment property in Sydney, you're probably kicking yourself right now because you've lost so many other capital gains, the opportunity cost of it.
Well, you look at. We were talking off air a second ago. Like I had assets I bought in 2020 in Brisbane that I just sold for more than triple what I paid for them. Right, more than triple. In the same time that Sydney did barely anything.
Yeah.
And literally, and the market's still moving. I sold them to cash out to go into the primary residence, but you literally more than tripled in that time frame. Man, Perth has more than doubled. Adelaide, I've sold assets in Adelaide that are more than tripled in that same time frame as well. You know what I mean? So it's like man, there's always opportunities there. But the joke that your primary residence is going to be in the best location in Australia for capital growth, it's exactly that. It's a joke. It's not going to happen, man. It would be such a fluke if it actually was, So yeah, man, the ability to multiply that debt somewhere else is so much of the reason to be able to take it elsewhere.
And what would you say to people that listen to that saying like, I bought in this city, it's tripled, that city, it's doubled. Yep. If they're looking at that, it's like, well, did I miss the boat? What would you say to them?
There's always locations to invest.
Yeah.
Where else? Where's next?
Yeah. Well, that's for you. That's for you to tell me. Well, I mean, that is.
You know what I mean, though?
That is,
You know what I mean?
No,
I was like, I've named 3 cities. Like, there's the whole country.
There is.
And yes, man, the market has moved through different cycles. But again, if you're talking about something in Sydney that's growing at 1% per annum a year versus somewhere else, even if you could just get 10% per annum, okay, there's a 10x return on what you could have got. Yeah, and then if you can multiply that debt by 2, 3, 4 times, we're talking 20, 30, 40x return on what you would have here. And it would be cheaper to rent here than it would be to own the mortgage anyway. So it's again, let's keep multiple. Let's look at the velocity of money and how much further you actually will be in front by going down that path versus a primary residence.
No, for sure.
Sorry, man, I'm getting fired up here. I get passionate about this stuff.
Well, we got double bonus, so we all won from that. But we do have to get on to our
all right,
5
let's go.
mistakes. Are they in any order? What's number 1?
They are in order, man. Okay. They are in order. And I do this. I like to sort of structure these things out for an intended reason, right? And so for me, man, the number 1 that I always see, and I like to start with the end in mind with this, is having no clear exit strategy.
Yeah, right.
So again, if we're really going to talk about bucking the trend in terms of what people are talking about, exit strategy, man, sell downs. It's probably one of the most taboo topics in Australia when it comes to property investing. But knowing when the right time to exit is, or exiting when the time is right for you, is such a massive needle mover in property investing. And so many people get this wrong, and so many people try and challenge me on this as well. But I personally have seen the effects of selling down properties in the correct areas, and again, understanding the creative lending piece to then how do we multiply that debt elsewhere.
As in the positive effects of selling down.
Of course, yeah. I mean, this is the thing, man. Like, let's say you invest in a high growth location, and whether it's a great yield or not a great yield or whatever it is, for one, if the market stops running and it's finished doing its job, if it's a growth asset, what else is it actually in the portfolio for? You're going to sit there for 10 years and let it do nothing to then grow again? Maybe you could extract some equity, but you're going to hamper your borrowing capacity and your ability to keep moving forward. Whereas if you sell it and you clear the debt and you get the cash back, people are like, oh, but you pay capital gains tax. Mad, beautiful. So I made profit.
Yep.
Sick. And so I got 50% of that tax-free as well. Beautiful.
So I got what I wanted, which was to make money.
Exactly.
Yeah.
You know, exactly, man. That's exactly it. And so when people try and challenge it, it's like, well, let's weigh up the pros and cons of it. And in reality, man, if you weigh up the pros and cons and look at a 5 to 10 year window, again, we talk about velocity of money. Well, what could that capital and debt do for you somewhere else now versus sitting there if we have to refi equity out of it to keep moving forward, but it doesn't do anything for 10 years? Inflation eats your profit. Negative cash flow eats your profit. Maintenance and all the other bullshit that goes with it eats all your profit. So when all of that gets weighed into the equation, man, it's an absolute no-brainer that when a property is at the right time to sell, you exit, man, and you redeploy capital and debt elsewhere. And that's why for me, the exit strategy isn't just at the back end, at the proper exit. It's an exit strategy relevant to each property, right? And so cash flow deals obviously don't need that because they're in the portfolio for the long term, or they should be. But all growth assets should have an exit strategy. There's zero asset in Australia from a capital growth play perspective that should not be sold at some point. Just doesn't make sense. Keep moving forward.
Why would you have it?
Exactly, man. Exactly. So there's multiple reasons for it. First one is obviously banking an actual profit moving forward. You're guaranteed to get stuck if you never sell growth assets. You could make $10 million a year. At some point, you will get stuck with serviceability. Yeah. Everyone will get stuck at some point with serviceability. So being able to sell down, clear the debt, keep moving forward. And then the other piece is you'll never get to, it will take you forever to get to an actual net positive cash flow position and hit those passive income retirement goals if you don't exit. Because if you pair really strong capital growth deals up with really good cash flow deals, when the growth assets have gone through their cycles, you sell them down, you bank the profit, you clear the debt, you use that's low yielding debt. You use those profits to then pay out high yielding debt, high yielding assets, pay those down. So you're getting a much better cash flow return from singular assets or the same dollar value assets that are producing a much higher return. And the growth assets might have produced heaps better growth. But that's what we're in the portfolio for. Sell them down, bank the profit, clear the debt, move on.
Yeah. They gave you the equity that you needed, the money that you needed to keep growing. That makes a lot of sense. Number 2, what's our second critical mistake?
Mate, number 2 is actually around mindset mistakes. And it's probably like a few different sort of loaded things in there. So the biggest things I've seen in 2025 is people still holding off with interest rates. A little bit more appetite coming back in. Now they've started to come back down.
They're not buying.
They're not buying because interest rates are still quite high. Now we're definitely seeing a bit of a transition back. Well, they are still, this is the biggest thing. There's so many people that came in 3 to 4 years ago when interest rates were in the 2s and the 3s.
Yeah.
We're still in the 6s. So from a short-term view or a short to medium-term view, we still look expensive. And so one of the biggest things that I've seen, and obviously it is starting to taper off now, but people still going, I'm going to wait till rates get back into the 5s or in the 4s or whatever before they'll take action, before they'll do anything.
Are these informed investors, first-time investors, or
it's
just a mix of everybody?
It's a mix.
The way that I look at that is, I'm quite surprised that you're seeing that, because the way that I would look at that is, well, that means you're going to be moving into the market at the same time everyone else is moving into the market. So then you're just buying it at its peak.
Yeah.
You know?
Yeah. Or you're missing out on, say, 6 to 12 months that you potentially could have got in earlier. Yeah. And the thing is, man, like obviously I'm gearing this conversation towards all levels of listeners, because I know obviously your audience has that. They've got experienced investors, but they've also got the beginner investors, people starting up, people potentially just getting their education piece that might literally be sitting waiting for the 6% interest rates to drop into the 5s. And so my whole philosophy around investing is if you've got the ability to and you can actually afford to, invest. Go and buy. If you actually can't afford to, it's a different story. If interest rates are at a certain level, you actually can't afford to release equity, buy another deal. That's a different story. But again, could you look at an exit that gives you cash back out, clears debt and goes forward? Yeah. And so it's understanding these things, but it's just being aware of that side of things and building appropriately. Man, one of the other big things is thinking short term. So allowing things like potentially not seeing as big wins as maybe like a year before deter them from wanting to continue investing as well. Not just sticking to a game plan. And even that in itself, I got a really good win out of this area or that area or whatever. So, I know that I can do it again or whatever. And it's not selecting the correct assets as well. So, and potentially deviating strategy. I did really well out of these few growth assets. I'm a developer now, so I'm going to go develop. Yeah. Instead of sticking at what made them money and continuing to follow that path. And so I've always seen when people sort of start to play that game, it's very hard to be a master of all trades. It's almost impossible, right? And so if you're going to pick something, stick with it and look to stick with it long term, because the longer that you do something, the better you're going to be at it. And one of the best and the greatest and the most lucrative ways to actually make money in investing is to be a it's like an actively passive investor, but buy the correct assets in the correct areas and let the market do the heavy lifting.
Yeah.
Buy well, buy the right asset, buy well, but then buy in the right locations to do the right thing. Don't get ahead of yourselves with something that might be, beyond your actual skill set because you may have had a little quick win here or there as well.
So the move into developing, I think a lot of people would have done that, seen their colleagues do it.
Yeah.
What are the inherent risks of that? Because I almost look at that and see, there's so many people that I talk to, it's almost like a natural progression. It's a natural transition. Yeah. Once you got the capital to do it, a lot of people jump into it. So what have you seen? Man,
it's the same as commercial. It's the same as you're developing as well. It's that next level that people like to go into, right? And so they do well out of, let's say they make $1 million out of 2 or 3 growth properties. They sell them down. They do the right thing with the exit. They sell them down, they bank the profit, and then they go put all the cash in one project or all the cash in one big commercial deal.
Yeah.
And then they're done. Like, how do they get it back out? The dev, if the dev goes correctly, they might get their cash back out and hopefully a profit in 2 to 3 years. And the commercial, a lot of times it's a lot harder to rinse equity back out of it. You got to wait on growth, which is associated to the yield and the yield increase. So yeah, man, there's so many inherent risks.
They're moving too soon.
Yeah, they're not in the. Yeah. To put it, to be direct with it, they haven't earned the right yet. In my honest opinion, they haven't earned the right yet. Because what you want to do is you want to keep building that asset base. And then even if you do peel some off at some point to invest it in there, there's different times to do it to really maximize and to also hedge the bets and I guess spread the risk. That's the biggest risk I see that people take is they almost go all in on a strategy that they don't fully understand.
I think that's a great way of putting it. They haven't earned the right yet because you don't have the expertise. You certainly don't have the cash.
Yeah.
Almost to our trust structure discussion before, people, if you move into trust structures too soon, you lose a lot of that capital gains that you could have had, a lot of the tax benefits you could have had if you move into commercial too soon. Because everyone is now looking at commercial. Oh, this is my next amazing way of making money. Yep. Well, not if you move in there too soon. And then you've got, you might be making 80K a year passive income. Fantastic.
Yeah.
But now you're starting from zero because you just lost all your money. Yeah. So now you're going to have to go back to that foundational stuff again.
And that's where the whole strategic game plan comes into place, right? And that's where this is where people, again, short-term thinking, they make that decision to go in and do something like that, which 80K, let's be honest, it's not even the average Australian income right now. So you're not retiring off an 80 grand income. Yeah. So it's like, are these short-term decisions stopping you from the bigger picture goal?
Yeah, for sure.
And that's where you have to constantly have a great strategy. Great strategy always has to be revisited, replanned, re-executed. But you want to stay on the right path. So sometimes tweaks need to be made along the way. But there has to be the right time to bring this sort of stuff into the picture rather than just, I've got the cash now, I'm going to do it. Yeah. And that's where I see so many people actually fall over with that as well. And we have definitely seen it for sure. And that kind of leads me into the next piece is kind of that DIY investing as well. Now, everyone in Australia thinks we can do everything, right?
Oh man, everyone's a handyman, everyone's a tradie.
And man, I've been a victim of my own misconceived beliefs about my own ability sometimes as well. Like we all are.
Man, I had one when I moved into my place. I started doing wiring, and I sent my brother-in-law a photo of this wire, and he calls me up, he's like, "Do not touch that. Get down." I'm like, "Oh." I thought it was okay. I've turned the power off. It's like, mate, yeah. So, man, be careful.
I remember getting zapped on one of my first renovations, man, and it got me good. Yeah. And yeah, man, I've done a lot of silly things, and we all do. But it's one of these things, man. It's like, know what you're good at, know what your skill set is.
Yeah.
I reckon one of the things that took me the longest, and we talk about School of Property. I'm not here to sell School of Property to go through it, right? But man, I look at School of Property, and to me, it's my way of giving back and give a resource to people that potentially don't want to use a buyer's agent, right? They want to go down this avenue themselves. Well, 16 years of learning in here that has built what almost every Australian aspires to be able to achieve or more is effectively in that course that teaches people how to actually build this stuff properly. And the reason why I did it, man, is because I never had a resource on that sort of level when I came out. And in my honest opinion, there's no other resource like it out there on the marketplace. And man, it's one of these things is myself when I was younger, I wasn't willing to pay for that amount of advice and experience and knowledge. And at the end of the day, yes, that does come at a cost. You have to pay to get that sort of knowledge and experience from someone. But man, property is such a leveraged return. It's such a leveraged asset. A 1% increase on a $1 million portfolio, right? Which isn't that much, is 10 grand, right? Just that, just 1% increase. You get a 10% increase, talking 100 grand. But if you get yourself to a $2, $3, $4, $5 million portfolio, but what about if the lessons can take your portfolio from $1 million to a $2, $3, $4 million portfolio? And instead of getting a 1% return, you get a 10, 20% return. So it's not looking at what something costs you, it's looking at what something makes you. Yeah. And when I actually learned that, man, I actually learned that in business before I learned that in property. I had learned it earlier in property, but I'd never heard the saying. Yeah. And then when I heard the saying, it made me really realize, and whether it comes down to a buyer's agent, whether it's a coach or a mentor, whether it's a course or whatever it is, it's actually going to level up your thinking and your ability. The whole idea of something like that and getting access to that knowledge is to circumnavigate the years that you might otherwise have spent learning and costing you money with it. And so I look at the hockey stick run that I had that was super slow for the first 7 years. And then when I built my team and I had the people around me who had done what I wanted to do, man, the explosion that I had after that fact was crazy. Yeah. It was crazy. And so, man, this is where it's just like DIY investing versus getting someone in your corner that has done what you're trying to do. And again, man, that's why I do the webinars every single month, because you have new people coming in every month. You have people who are still trying to learn up, going through different levels. So they might scale to a different point in their portfolios, and they come in and they throw the questions at the different level they're at. And they may be 2-3 properties ahead of you, and then they're asking questions, and then you're going, oh shit, so that's how I get to this level to then go to that level. And so the exposure to that knowledge and that experience, man, to me, it's almost priceless, because again, if you can take a 1 mil portfolio to a 3 to a 4, and then take a 1% X return, a 1% return, and turn that into a 10 to 20, it's ridiculous, right? We start talking 10 grand to 400 grand,
yeah,
right?
For sure. The scale of it.
Exactly. And that's the beauty of property, man, that leverage return. But I've always found, and I suffered from this as well, not wanting to spend the money on getting the correct advice, or paying for the right people that would get you the right results. And man, you're cutting off your nose to spite your face, because you're not going to get the results if you don't have the right team.
In terms of partnering with the experts,
yep.
You and I were talking about the DIY, the renos. Everyone loves the idea, and I think it's so tempting for so many investors, like the flipping is, I made all this money on flip and it's really cool, and you think you're really cool. You would have seen some mistakes, I'm guessing, throughout your time.
For sure.
Can you shine
of like
light
renos
on
and flips?
Yeah.
Oh, dude, there's
'Cause, I mean, if you're not working with someone that knows how to do it, you kind of you can kind of cause a few headaches for yourself.
For sure, man. Dude, I've seen heaps of people lose money, especially early in the piece doing it. And what I would say is, if you don't have that specific skill set yourself, don't take it on. Unless it's something like literally paints and floors and maybe a bit of a kitchen or something like that. Like
a glow-up.
Man. Like, a little bit of makeup, that sort of thing. Like, not going crazy, man. Like the little stuff. And the area that you're talking about is worthwhile, and maybe near to you. But see, people want to travel to, they live in Sydney and they wanted to travel to Perth to do a renovation. So they took themselves out of work for a week or 2 weeks. Yeah. Let's say 2 weeks. However long someone thinks a renovation is going to take, double it. That's at least how long it will take, right? Yeah. So let's say they thought it was going to take 2 weeks. Ends up taking 4 weeks. So lose 4 weeks of work, average Australian income, 100 grand a year, 2 grand a week. So there's $8,000 you just missed out on. And those 4 weeks of holidays that you now don't get back.
Yeah, for sure.
So you're going to be cooked. And then all the things that you think you're going to be able to do, like it undoubtedly blows out. You're probably not going to do as good a job. You get this extended time frame of when it could have been leased versus being leased. And so it's just like, they're the stories that I hear all the time. And probably one of the other big things that gets thrown in on top of it, people thinking they can do it after work. And the 2 week reno turns into the 6 month reno because they're cooked. They never want to touch a paintbrush again. Everything takes so much longer than they thought it was going to take. There's a can of worms behind every wall. And so, man, like they're probably the biggest things, like taking on things, not just kind of getting the experts to do the expert stuff. And even if you want to finish something with a paint to feel like you've been involved in it or whatever, but it's looking at the cost versus return analysis and what really makes sense, what really makes dollars and cents, not just, I'm going to renovate this property for X reason as well. I mean, I've seen some absolute shockers, man, across so many different things that are just blowouts of people just underestimating what something's going to cost and underestimating their time frame side of things. That's probably one of the biggest ones I'd literally probably say is, I had a client in WA. There was a property in southern Perth that I'd gotten for him. And he thought this renovation was going to take him 2 weeks. It took him 6 months.
Wow.
And every weekend he drove down there I think on a Thursday night he'd drive down there, he'd work from home on the Friday, and then he'd work all weekend. It took him 6 months to do it.
What?
So there's the lost rent as well.
What was he expecting to get done in 2 weeks?
Man, I think he thought he was going to do paint, floors. So he had to obviously fix the place up a bit. Paints, floors, landscaping, and I think it was kitchen and a bit of a bathroom refresh.
No, in 2 weeks.
I've done those renos in a week. but I've done a lot of those renos. Like I did a lot of those renos in my 20s and I've done them in a week.
Yeah,
but I've done 16 to 18 hour days.
Yeah.
You get a handyman in to come help you with a 2-man jobs and you absolutely cooked at the end of it.
Yeah.
But I had done like 10 of them before to get it down to a week time frame.
It's not
He'd
your
never
first
done it
rodeo.
before.
Yeah.
And then everything, then can of worms pop up and all the rest of the sort of thing.
The unexpected stuff.
Yeah,
you
and
know?
you've got to know like what you need to get people in for as well. So there's different things. You know, I've had lessons of sitting there for 4 hours trying to unbolt a bloody toilet and all the water coming out of the cistern dropping on 30-year-old housing commission floor and just squatting in a pile of piss.
Yeah,
you know what I mean? Like and just going, I'm never gonna do this again.
Yeah,
so
why do I do this?
Lessons learned, man. Never do that again. Plumber comes in and does it.
That's the economics of it. Because
Yeah.
there are going to be times where it actually does cost you money by being cheap. You lose money by being cheap.
100%.
You have to know when to bring the experts in. Man, it's I find it so crazy. So the crux of this lesson is realistic timeframes. With the DIY, with the flipping, baking in when things go wrong, they will go wrong. Baking in unexpected hurdles. So your advice, double the time that you think it's going to take.
Always, yeah. For sure.
That's cool.
But the DIYs across the board with that. There's whether it comes to the knowledge base, the execution, all this sort of stuff, man. Like it's the way to circumnavigate everything is find someone that's done what you're trying to do, and then pay for that knowledge.
Yeah. I mean, it's gonna pay you off in the long run as well. That was number 2.
That was only number
That was
two,
number
man.
2.
Yeah, we got to rip. All right, so next one, man,
Number
is
3
is macro and micro market mistakes.
Yep.
This is one of the biggest ones we see, and we see these every year. But this year, I think was a really big one because a lot of people were a bit lost in terms of where to go this year. A lot of cities was kind of like you said we were talking about before, have seen doubling, tripling in the last like 3, 5, 6 year windows as well. So people not really knowing where to buy, and a lot of them kind of turning back to buying a primary residence or just investing in their own backyard.
Yeah.
And so, man, I see people like kind of when they're investing in their own backyard, it's kind of like that comfortable decision versus the one that might take a little bit longer, but that intelligent decision, right? And so we actually saw a bit of that this year of clients coming through, like especially freshies, kind of coming through, like never done a deal with us before, and maybe only found the podcast this year, and they come through and they kind of made that mistake.
Freshies.
Oh, it just came to me just then. Yeah.
That's a good one,
They never worked with APS before, right?
Yeah,
so
freshies.
like,
Freshmen.
Yeah, that's
we'll
it.
go with that. Yeah.
So yeah, man. So I'm gonna have to we'll input that into the business.
Right down. Yeah.
Yeah, man. So it's I've been seeing a bit of that as well, and even with School of Property, on the calls and everything with that, and the feedback we're getting from that, a lot of people kind of had made that mistake as well and bought in an area, and it hadn't done anything, whether it was this year or in the last couple of years, but then not making those decisions to do things like the rent vesting and then repositioning the debt and the capital somewhere else, holding onto it from the comfort side of things versus the actual logical financial decision of potentially a sell down and moving it on, and moving into the rent vesting model to keep investing. So things like that, man. One of the biggest things as well from obviously market indicators is following the herd. So waiting till markets run, not preempting it. There's a lot of things, man, as well around like data that people use. A lot of BAs like to talk about data, investing with the data. So often, man, the data is 6 or 12 months lagged. And if you're purely going off the data, you're undoubtedly buying in an area that's already moved. There was an area in particular that we invested in quite heavily last year, and by the time we were exiting all the other, we were sort of finished our buying, or we probably had about a 3-month crossover between we were buying and when other BAs started coming in and buying. And then the market sort of by the time we pulled out was at like 30 to 40% up sort of thing in that time frame, and we were just competing against homeowners and first home buyers, and that was for about 12 months. That's all we were competing against. And then as the BAs came in, unknown of market knowledge, just started blowing it up and going to a different level. We probably had
whatever they can because they know that this postcode's a place to be.
And dude, there was no stock, and so like it kind of in that transitionary period, they sort of came in, but the numbers on the board data wise at the time was that it hadn't posted any results. It hadn't posted any growth, or it had been up like 2, 3, 4% or something like that. When the market had actually done about 35 to 40. So it's understanding the correct metrics you should be targeting. And again, man, that all comes down to the piece of the DIY investing versus paying for the knowledge as well, to make sure you're making those correct decisions and getting in early. Because man, you think about that side of things, 30% on a 500 grand asset, that's 150,000.
Yeah.
That's a lot of money, man. So it's really understanding that piece and not just following the herd, like really doing your own research, understanding what's actually going to drive a market. Especially if you are doing it yourself, man, getting on the ground, or if you're using a buyer's agent, make sure they're getting on the ground and understanding it all properly. So so many things to do with the actual market side of things with that. understanding the data points that are really actually going to give you the biggest result, and not just following the herd and what's being spoken about.
Oh, for sure. And I think this is inherently an industry where people do follow herds, right? It's like,
for sure.
I know, I saw that, you know, there was mad growth in this part of Brisbane. It's like, well, the growth's happened.
Yeah.
And to your point, it's been posted. People have known it. People have already made their money. And now you're just jumping on the last move.
And there's comfort in numbers, right? And I think that's the biggest thing. There's comfort in the herd. There's comfort in the numbers. And I think that's where people take a lot of comfort from that. But the biggest wins are made when you it's really
before the wave,
for sure, the trailblazer, right? And it can be really nerve-wracking to do. Man, I'm always nervous when I enter a new market because you're always worried: is it actually gonna perform? But at the end of the day, man, we've proven the result again and again. So we want to make we back ourselves now that we make the right call.
Postcode, and you're like, okay, this is the place to be. Other BAs aren't here yet. I'm going in here. What's your process?
We get on the ground.
Yeah.
Negotiate on a bunch of deals. We get on the ground first, learn all the pockets, learn all the streets. I'll normally buy between about 5 to 10 properties when we kick off in an area, because then we learn the process and transactions of specifically, it's not so much the postcodes, more like the council.
So
the council,
the council, or like the
well, it could be different states as well. Yeah. And so we'll trial different BMPs, different conveyances on my contracts, and then man, you work it out pretty quickly. So I normally acquire a fair bit in the first month or two, and then starts filtering through to clients if everything else sort of ticks off as well. But if I'm going in there buying 5 to 10 properties, I'm pretty confident, so it doesn't take long before it starts filtering through.
It shows you got skin in the game.
Always, man. That's why I do it.
Yeah,
that's always why I do
lead your clients. But I mean, you see it all the time, and we hear some shocking stories at SPI, like BAs flogging stuff that they never gone to see in areas. It's like, some agents send them like a video walkthrough, and they're like, that'll do. I'll just flog it to a client. Man, it's there's some no bueno actors out there that are BAs. So the fact that you've actually putting your own skin in the game is evidence that you believe the product.
For sure. Man, the proof's in the pudding. With client results, with mine results, staff results, but specifically client results, man. That's why I love to do investor stories at least once a month. Just because it just shows the wins that so many of these guys and girls are making as well. So
how many staff do you have now?
Oh, mate, I couldn't even tell you.
Yeah, it's just growing.
Nah, we got a good team, man. We got a big team. It's just kind of condensed into different kind of structures within the business as well that support obviously the client base across the board. So, mate, the support side of our business, man, is massive. So just obviously everything, linking everything up.
Mate,
man,
you didn't even give me a ballpark figure.
I mean,
but it shows you're growing. It shows you're growing.
Man, I don't like to talk numbers, man. I'm not one to. There's a lot of BAs that love to shout the numbers of the team and the rev and the deals they're doing every month. I don't like to do that. I prefer to keep that stuff to myself. So
no, that's fair enough. Well, I think you can look through the what's your podcast called again?
Scouting Australia.
I listen to so many of them. I don't know why I just had that mind. Like, I mean, you can look through the Scouting Australia podcast, and I know a fair few of your guys appear on there. Jimmy Ibrahim's one.
For sure.
Now we're up to fourth critical mistake.
I'm going to rip through one final piece of the macro micro market mistakes. So I think it all sort of ties in together, man. And we mentioned before around interest rate movements. And man, I think the thing to understand around the interest rate movements is not all areas are going to perform the same, because different areas are going to fluctuate differently compared to how much of a boost that might do to an area. And then also understanding where the strongest population growth is going, combined with where the new grants are going to have the most effect as well. So the biggest mistakes I'm sort of seeing from a actual market selection side of things is not understanding those probably 3 key parameters in unison: how interest rates can affect the market combined with the population growth, compared with where is going to see that extremely strong demand from the new grants that are going to be coming into effect, which is massive stimulus going into the economy and into the marketplace. When you understand those 3 components, that really should tell you a very clear picture in terms of where would make a lot of sense to be buying and investing in. And some of the biggest mistakes I'm seeing is people just completely disregarding that and not factoring those pieces into the equation to help them select their markets.
So for our listeners that aren't aware, they've actually moved the first home buyers guarantee scheme from January to October 1. And what that's going to mean is that if you're a first-time buyer, you can buy up to 95% with no LMI, so the government acts as a guarantor for that 15%. It opens up in Sydney for example, the cap on what you can buy goes from like 900 to 1.5 mil.
Yeah, it's massive.
Huge.
It's massive.
I think the rule of thumb is it's the median price of the city plus 10%, just to make it a little bit more encompassing. With that no stamp duty as well, the first home buyers grant. I think it used to be, now obviously it was city by city, state by state, but I think it used to be new builds only, but now it's both new and old builds.
Yeah.
Man, this is going to be huge.
That's probably the biggest thing. That was actually what I was going to jump in with right at the end with that is the biggest differentiator between anything in the past to now is the fact that it's unestablished as well.
Yeah.
And that hasn't been in play for a very, very long time. So obviously the government for a long time was trying to stimulate, and especially state governments, they're trying to stimulate new builds because that stimulates more development, which they obviously get more cash in the bank from both land tax of more lots being made, whether it's, in units or townhouses or actual blocks of dirt. More rates, obviously, that come with that, more land tax that comes with that, more state rev of stamp duties and everything else as well. So there's so much reason for them to promote new builds, plus keeping the building industry going and strong as well. So there's so many reasons for it to do it. It's been so long. There are some states that did include established in their first homeowner grants for quite a while. This is the first time there's been like a decent push for established to still be in the equation. The simple fact is, it's the government's way to try and appease the masses that it's the right call, the right thing to do in terms of helping ease housing affordability. All they're going to do every time the government interferes with housing affordability, it does the exact opposite thing.
Yeah, for sure.
And the market will have a rocket put under it from the bottom end of the market, which is a concern from housing affordability because it'll push the whole rest of the market up. So,
mate, this is the first time you and I have ever discussed politics on the podcast.
Yeah.
But look, I couldn't agree more. I'm trying to unpack it a little bit, but you've got well over half the market there, 70, 80%. I don't know the numbers, which were immune from the stimulatory impacts of the first home buyers grant that now will have them.
for sure.
Being moved to October 1. I think we're going to see house prices boom off the back of this.
It's going to be interesting to watch. I think that's what we can say. I agree with you, man. I agree with you. And I said it for a while, like leading up to it, and then when it was in. And the thing was, the government's played their hands, correctly in the way of winning an election. And then the thing was like when one of them would bring a housing policy out, the other one would match it, and the other one would bring a new one out, and the other one would match it, because they knew that's how they, like if one of them fell off the scale with everything to do with housing affordability, they would lose. So it just almost became, half of the election was almost a battle around housing affordability and getting new people, young people into homes as well. So unfortunately, every time the government interferes with housing, it creates mini booms. Look at COVID and the new home builders boost. It was the easiest way to eat up all the stock, get all the build. Look at what house prices did in the 12 months post the builders boost coming into effect, which was a $25,000 grant for any new build, as long as you were moving into it. For anyone, no longer first home buyers. First home buyers got that on top, as well as no stamp duty.
Yeah.
Ever since they did that, man, the house prices have been on the craziest run in history.
Yeah, because now you're just printing money.
Man, and it's so much stimulus into it, and we didn't have enough workers to keep up with it, or materials. So every time they play with this little lever, which is politics in the housing market, something like this happens. So it's man, there's a lot of things to unpack within it, but it's only be good as an investor if you own property.
Asset classes, areas, what do you expect will be most susceptible to these changes?
Well, the most immediate impact will obviously be on the bottom end of the market, anywhere up to the caps in the relevant state, city, everywhere that someone owns property in. That will be the most obvious one that will be hit first. My thinking is that it will obviously push into the next bracket because the people
filter up.
man, because the people that are there at that price point. I don't think it will overly affect the top end of the market, but I really do believe it'll definitely drive the bottom end of the market, and then obviously pushing into the mid tiers as well. Because as people make more money, and let's say you own something for 700 and it went to $1 million, or you own something in Sydney, it goes from $1 million to $1.5 million. For the same debt level, if you could sell out at $1.5 million and someone gets that grant, but you weren't eligible for it anyway, well, you now have another $500,000 worth of cash, so you could sell it, and for the same debt level in comparison, buy something for $2 million, be sitting in the same debt level. You know what I mean? So it's man, I think it will have that direct flow-on effect, involved with that as well. So it's gonna be interesting to watch, man. It'll be interesting to watch play out, but yeah.
Watch this space. We'll probably have we can't look into a crystal ball, but I reckon in a few months' time, where you and I have our next chat, we'll probably see some pretty decent returns off the back of it.
It'll be interesting, man.
Number 4 critical mistakes.
Yeah, man. So kind of leads in with what you were discussing right at the very start of the potty as well, the financing and structuring mistakes. So all around, obviously, creative lending. The lack of knowledge around creative lending is the biggest piece. So many people getting this wrong, either having no understanding of it, not even knowing that it's available, or just completely getting it wrong, thinking they're doing the right thing and then also getting that wrong as well. So the lack of knowledge around that piece is one of the biggest, probably the biggest mistake that I've seen made in the property market this year that can take people to a lot of different levels. And in reality, you get this wrong or you don't understand it, or you don't even know it's in play. It could be costing you, depending on your income, depending on your starting position, anywhere between, a deal, 2 deals, 5 deals a year, depending on where you're at, that could be unlocked by this. And remember, like what I said, there was a year. So 1, 2, 5 deals a year. So how does that compound? It means in the next 5 years of investing, if we were doing an extra 2 deals a year, let's say instead of doing 1 deal a year, you're doing an extra 2, so you're doing 3 deals a year. So in 5 years, instead of having a 5 property portfolio, you could have a 15 property portfolio. Or even if you could just access one more, instead of having a 5, you could have a 10 property portfolio. And people might be like, oh, I don't want to build a 15 property portfolio. Well, have you worked out the strategy in terms of what your goals are and what's actually going to get you there? Because for most people in Australia these days, it's not even 100 or 150. It's $250,000, $300,000 is the goal. 500 grand is what I get hit with all the time these days. 500, man. That's
bullish.
It's crazy, man.
People are really going for the stars.
For sure. And they're understanding it might take, let's say it takes a 10-year window to build 250. But then if they can build a 250 in 10 years, then they could double that in 5 years.
Yeah.
In all reality.
The returns compound, to your point.
For sure. It snowballs, man. It goes to a different level. And your borrowing capacity massively increases, because if you've got another 250K a year coming in, plus assets that are growing in value, bang, the snowball's real. So yeah, man, like in all reality, a large passive income goal comes alongside a large size property portfolio, at least in terms of number through acquisition over the period of a portfolio. But yeah, man, like if you look at that simple thing, if you can unlock that from a creative lending end, instead of going 1 a year, you can turn it into 2 or 3 a year. Or you have the ability to do 5 and you do them all in a year, but you don't understand how to actually properly structure it. Well, that could be 5 a year that you could actually be doing if you knew how to do it properly. So yeah, man, that is probably one of the biggest mistakes that I see people making as well. And probably the other thing around that is neglecting proper structuring. So regardless if it comes to actual borrowing capacity side of things as well, it's actually from a tax implication side of things. And so I've seen this isn't as big as getting the creative lending piece wrong, but I still see it a lot of the time with people getting that actual structuring correctly from a tax perspective wrong as well. And man, there's just so many benefits of when you know how to structure things properly, and especially when you do it in conjunction with from a borrowing perspective, from a creative lending perspective, the results and the net benefits can compound massively, especially if you get the tax component wrong versus getting it very right as well. So again, that's one of the things. Again, like that's something we do in a lot of detail with my own actual personal accountant within School of Property. We go really deep on that because it is, it's mate, you get 10% wrong in a $2 million sell down, we're talking 200 grand. You get 20% wrong, we're talking $400,000. Like it's the sort of thing you want to get right. Like you have to get right, or it's going to cost you significant dollars. So they're the two big things, man. Around that structuring piece, you really want to get right.
So in the tax portion of that,
yes,
is that a well, not a suggestion, but just to make sure I've got my own head around it. Would that be, say you've got an asset, the yield is what it is. You've got the asset for the capital gains, but you have that under a trust. So then you don't get the capital gains benefits as if you had it in your personal name. Is that kind of where we're going with that?
All right, so we'll give a bit of value, to listeners right now. You have something in a trust structure. You still get the 50% capital gains tax exemption. In Australia, in the correct trust structures, you still get a 50% capital gains tax exemption.
In the correct one?
In the correct one,
okay.
Yes. And so where a lot of people get this wrong is... Actually, yeah, we'll give some good value around this. Like a lot of people will buy all their stuff in their personal name. Or if they have the greatest, let's say a man or a woman, whoever makes the most money, they got the best borrowing capacity, so they'll buy it in their own names. And what they don't realize is, or they'll buy joint names, because I've got the borrowing capacity, but we have to split it. But let's say, let's say the woman is on 200 grand a year and the man's on 100 grand a year. And that property, they bank, $200,000 in profit or something like that. If, when you go through the sell down, $100,000 would be tax free, and then $100,000 would be exempt, because the $200,000 50% capital gains tax exempt, only $100 grand's tax applicable. Now the woman in this scenario making 200 grand a year, she's in the highest tax bracket, so the 50 grand is at full tax rate. If you'd set it up correctly, if you structured this thing correctly, you wouldn't have to go 50% to the wife and 50% to the husband. You could literally divert all of it to the husband, the 100 grand, so he'd be able to keep the lower tax bracket up to the full 100 and save, in that instance, probably around about 20 grand, 15 to 20 grand with that one simple thing. Now, again, and this is where I was saying, like in that scenario of $1 million sell down, for every $1 million worth of profit you might have in your portfolio, get this right, there's an extra 200 grand per $1 million, 150 to 200 grand per $1 million. That's net. That's net. So that's the equivalent. Let's say it's 200. That's the equivalent of you making 350, 400 grand a year as a salary, just by structuring correctly and saving the tax. And so it's not even a loophole, it's just structuring it correctly. And so this is where, again, that's where so much of this stuff is so right. And so many people at the start get this so wrong. And that's where like they want to do the DIY or they want to, and it's like, but how much is this going to cost you in the long term, regardless of what it is in all? And that's why I say, like, all of a sudden these little tweaks, man, that could be almost like a 20x difference. When you get them right from the very start, we are talking hundreds of thousands of dollars of difference if you don't get it right versus getting it right.
Yeah, for sure. And that's really interesting insight. I made a note sometime earlier in this podcast, which I feel like has been going on for a while. You know, people are still learning. And to your point about you didn't necessarily, when you started your journey, you didn't have a Sam Gordon.
Yes.
Right. You didn't have someone handhold you on this.
Yeah.
These are crumbs that you picked up along the way, that you learned along the way, and then you spoke to a good broker, you spoke to a good BA, and then you slowly accumulated this wealth of knowledge. The science that you've kind of settled on around this was being learned up until quite recently, right?
For sure.
And so you learn these little tidbits, and I think that's fantastic.
Mate, simple fact on that is you should always be learning. I'm always an open book, man. If there's something I can learn, I'll always learn it. I'll never, you always want to take information to see what you can actually pick things from as well. But yeah, man, it's mate, there's levels to the games as well, right? And so there's people that come in that can learn from my first 5 to 10 years of knowledge, and build a considerable portfolio. And then the remaining 5 years of knowledge that I've picked up specifically, you could build an unbelievable portfolio that allows you to buy, anything you want and build anything you want in your life. And so what I really understood, 2 components. You need to take advice from someone who's done what you want to do. And then you also obviously need to put that into action as well. You know what I mean? And so they're the two really key things, man. And just understand there's different levels to this game. That was actually point number 2. I had a mental block. Okay. There's different levels to this game. You see how I can make shit up on the go. But man, there's different levels to this game. And that's what you have to understand. And man, when you can learn from someone who's been through those levels and can guide you through those levels, whether it's me or someone else or whoever it is, as long as you're taking it from someone who has been through those levels, they can help you get past those and unlock their next stage. Because that literally is all property investing is. It's unlocking the different levels to allow it to snowball. And then all of a sudden you might go from 1 property a year to 2 properties a year, and then 3. And then all of a sudden, if you want to do 5 a year, you'll get to a point where you can because you've unlocked the different levels. Yeah, for sure. One final point I'll make on that. You said about building my team. I will make it very clear. I never met a good BA. Really? I got burnt by a BA.
I did know that story. Yeah, where they kind of not fleeced you.
Yeah, 100%. I got fleeced. I got burnt, man. 100%. Yeah. No, man, I'm the first to admit it was the most expensive lesson in my life at that point in time. And it was probably the best lesson I ever got taught because I got burnt 10 grand. From someone that I really looked up to, and man, I wear that as a badge of honor almost on the chest because I went in with the rosy colored glasses and got burnt by someone they were just fleecing clients, man. And yeah, mate, it just set a really straight moral compass for myself and for APS because I was 26, man. I was making 70 grand a year, so I was netting 55.
10K's a lot.
It was heaps, man. 10K's a lot even to me today. I would obviously be pissed off. But at that age, man, it was almost a quarter of my net income to be burnt that. And thanfully, I never bought what he put in front of me, but I had to walk away from that. So
what was it again? It was
a non-refundable 10 grand. It was just, man, all these deals. As soon as I signed on, we'll do this strategy. We'll find the right deal. It might take, 10 weeks or whatever to find the right deal. Bang. As soon as I signed on, I was getting sent I got sent 6 deals in a day. And I was like, what the hell?
Man,
it's crazy, man.
But it's a good lesson. It's 100%. A good lesson that you learned from because...
And it's a good lesson I can pass on to people as well.
Yeah. I think that's a fantastic idea, a lesson for people that are listening to this podcast and might be discerning BAs and trying to pick a BA. One thing my broker said to me was, it was something like, Liam, when you're picking a BA if your BA has a deal for you on day one, run away.
100%.
Because, I mean, if the deal is so good, someone would have bought it. Like,
For sure.
I mean, the BA would have bought it himself if it's just sitting there waiting around and there's no clients to take it.
Mate, one of my favorite sayings is, man, like buying deals, like great deals, it's not like going to Woolies and something being on the shelf on sale. You know what I mean? It's not on the shelf on sale. It has to be gone and sought. It has to be found. So yeah, man, that's a great piece of advice from your broker, man. He's obviously been around the traps a bit as well, because it's never the case. You know, it's never the case. Great deals have to be sought. Great deals can be done in like, we've had deals that had to be done in 30 minutes, 60 minutes, because other BAs are coming in with offers 30, 40 grand higher than ours, and we have to get it done. You know, to really secure it at that sort of money. Because once the contract hits the table, and people might say, why would someone do a deal with you 30 grand less if it's incoming, another offer's incoming? It all comes down to relationships. It all comes down to the art of the deal and understanding the art of the deal and how to really put a deal together. But then the relationships. And when the relationships are absolutely bulletproof, you can get a contract on there and it's submitted before the other contracts come in. Because when the other contracts come in, it's done, right? But if you can get it in there before, and it won't always be the case, deals don't always have to be done in 30 to 60 minutes.
If you think of it from the agent's point of view, right? A buyer's agent can make a selling agent's job really easy.
For sure.
If you've dotted your I's, crossed your T's, if you've got a buyer who's serious, that's got finance done, that's got this done, when you've got your building a pass, this, that, everything's lined up, ready to go like a machine, and you can just road it out. That's really good. From a selling agent's point of view, mate, we hear it all the time, because obviously I'm also the editor of Real Estate Business. You know? From the selling agent's point of view, there's always stories of bad BAs out there that waste agents' time. Yeah. And then they're there for months. You know, this BA's been stringing them, oh no, my buyer's gone. It's like, mate, I had this for you. Yeah. Like we've been talking about this for months, and you know, haven't been listing it. And then that selling agent's never going to work with that buyer's agent ever again. There's that mutual level of professional courtesy, I think, is the best way to look at it.
For sure, man.
Now we've got one more to go. I think
man.
Fifth critical mistake that you saw from investors in 2025.
Yes, last one. And we've kind of covered this as well, though, with all the different tangents we've gone on, which I have loved. But it's shooting from the hip without the proper knowledge or education. And so I think I can't remember exactly where it got covered off in earlier, but it's almost, actually it was a little sub point somewhere else, almost being like that DIY investing. And yeah, man, like really just going out there, shooting from the hip without the proper education, without getting yourself, and whether it's podcasts or whether it's paid course or getting the right mentor, whatever it is, the biggest mistake that I think I see people make, along with buying a primary residence and thinking it's a great decision if it's not your dream home, alongside that one is saving your first deposit for 3 years, taking 6 months to get a pre-approval, and then going out there and just buying the first property you see, or going out there and just shooting from the hip, throwing offers out, not understanding market value, not studying a market, not really understanding is this the correct market or whatever to be in, and just like it takes them so long to get there, and then they rush the final piece. It's like being a sniper and setting up for 3 years to take the perfect shot, and then you're mucking around, and then bang, the target comes into view, and you're fumbling, you take a shot, you miss. You know what I mean? It's like, man, the execution piece is absolutely critical. And so having that drilled down, man, having that tied in, having that piece correct, we're not talking dollars and cents here. We're not talking a couple $100. We're not talking 10, 20 grand. We could be talking 500, 700, $1 million in terms of a purchase price of an asset. You have to make sure you're putting everything you can. If anything, man, I would almost argue that the first deal or two are more important than the ones, I would argue, because getting those correct, man, is going to lay the foundations for you to actually build upon to keep building the portfolio. Get the first deal wrong or the first two deals wrong. Like, for one, it's going to be debilitating to your actual journey. And it's just going to really stop you from being able to move forward, even mentally, because you've made those mistakes. But yeah, man, it's just when you get that right. So whether you're going through or whether you've kind of stalled at one or two deals, is there somewhere you can leverage their advice and knowledge from to take you to the next level? And I think, man, in Australia, and I love this about Aussies, but I also hate this about Aussies, we're so proud. And we almost don't want to ask for advice. But I've always found, man, I was like this. And all I ever did was, man, I read Smart Property Investment back in the day.
The magazine.
API, as a magazine before the potties, your investment property. Man, I'd never would ask anyone for advice because I felt awkward doing it. But ultimately, like, that piece and having, whether it's a mentor, whether it's a coach, whether it's a course, whether it's, you know, living and breathing the content side of things or whatever, but it's having someone that can guide you down that path, man, that will take you to a different level, unlock all the different levels as well. So don't just shoot from the hip. Make sure you've got a strategic game plan of building the portfolio. You're strategic in where you're acquiring, what you're acquiring. And man, you lay all those foundations correctly and you're going to have a great journey and build a massive portfolio, or build whatever portfolio you want to get. You know, you lay all those correctly, man. You have all the understanding around it. You execute correctly. It's all going to fall into place moving forward.
And I think with that, the other point is use good, reputable sources to learn from.
Yes.
School of Property, I'll do the plug for you.
Thank you, man.
Instead of your uncle at a barbecue, who's going to tell you to buy some shit off the plan place that's in an oversupplied market, a couple of $100K above market value because his mate bought there and thinks it's fantastic. You know, using actual.
I mean, there's two little points here to round out. Never take advice from someone who's never done what you want to do.
That's a good one.
And never be dissuaded by someone who's never done what you want to do.
Yeah.
So whether that uncle's trying to talk you out of property and get you into shares or whatever, he's probably never had experience in either. Yeah. Or whether he's only had terrible, investments, but he's telling you to go buy something. Never take advice from someone who's never done what you want to do, and never be dissuaded by someone who's never done what you want to do. Because if you are undoubtedly, especially listening to this podcast, listening to other investing podcasts, you're probably trying to go on this level, this trajectory away from potentially who you surround yourself with right now. And that's normal, because it's very normal, but it's also very normal in Australia to have tall poppy around you. They'll try and cut you down very quickly. Yep. So, whether you need to step into a different circle, even if it's just purely from the investing side, but a lot of the time you almost want to try and block out the noise and not have conversations with people who aren't in this, unless they're open to talking about it in a positive way, but the negative way will leach into your thoughts and will stop you from doing great things. So be very, very mindful and protective of who's around you, who you're taking advice from, who you're even talking to about this stuff, because they're not going to help you or help you move along with it. And there's difference between being like a bit of a reality check to make sure things are okay, and like actually questioning you, but in a positive way, making sure you're being diligent to outright trying to dissuade you or talk you out of it or talk you down something else if they don't properly understand it as well.
Well, clearly you've mentioned a few times throughout mindset. The mindset, the goal setting, the realistic expectation setting. A lot of it comes from your ability to self-lead and to bring yourself on this journey. Sam, you promised a bonus.
I did.
What's the bonus?
Man, it ties in almost with everything we've spoken about so far.
Yeah.
It's not having the correct team.
Yeah.
So again, biggest mistake I've seen. People not having the correct team and then holding on to those people. That's the mistake. Brokers, accountants, BAs, whether it's mentors, advisors, whatever it is. People haven't done what you're trying to do. So I always hammer on that, because I've had this experience so many times. Brokers, I would have gone through 7 brokers before I ended up with who I'm with now. And I've been with them for 7-8 years. You look at the portfolio expansion in the last 8 years, massive, right? The advice that I got around from them, and then accountant as well, same time. And so often the great people swim in the same circles. So I got my accountant from my broker. And I remember when I went through everything with my broker, and this comes down to the exit strategy. My broker was ballsy enough to tell me I had to sell something, that I was stuck. No one else would tell me that I was stuck. And then, so I made the decision to sell a property. It was the first property I ever bought. I swore I'd never sell it.
Yeah.
But it was the one that made the most sense.
Yeah.
And I sold it off. And then my accountant, who was my family accountant, who I'd got on with really well for all these years and who I trusted and all the rest of it, she told me that I didn't have the CGT exemption for the period in between. There was a period in between that she told me I didn't have CGT exemption for before I moved into my next house. And man, I was adamant that I did. And she was adamant that I didn't. And we went back and forwards for ages. And mate, I was making, it would have been around the same time I got burnt by the BA, or within 6-12 months after that. So I was making 70, 80 grand a year. I then was referred to, my broker kept trying to refer me to this person. I kept being adamant I wasn't going to go to this guy. And then my tax bill was coming up. And man, I finally spoke to this accountant, and I explained to him what I thought was the case. And he goes, man, 100%, you're right. What are you talking about? This. She goes, man, what's this chick do? She goes, he goes, she manages your parents' accounting for the business, for the farm. I go, yeah. And he goes, man, that tells me everything I need to know. And everything I hit this guy with question-wise, I couldn't stump him with anything. And put at this point, I was 26, 27. And so I've been investing for 8 years, consuming a huge amount of content. So I knew a fair bit of information. And that's why I was so adamant that she was wrong. And I actually went to a few different sort of accountants that she referred me to as well, that were like on the same page as her, and they're like, no, you don't, you won't be able to get this.
Why is that? Is that just because accounting is so broad that you'll have a lot of good business accountants that don't know anything about property? Or
Yeah, man, you have accountants that can do tax returns. You have accountants that specialize in business. You have accountants that specialize in different forms of business.
Yeah.
And then you have accountants that specialize in different forms of property.
Yeah.
And so, man, you need to find that top tier. You need to build the A team, because for me at that age, my accountant saved me 54 grand net after tax. That was probably my net income for the year, just about.
Sure. Yeah.
You know what I mean? So like, he saved me that as a net amount. That was a deposit for, at that time, I was borrowing 90% lens. That was almost 2 deposits in that,
sure.
just in saving.
Yeah.
And so, man, like, it just made me realize, and it made me just like, from that point, I was no longer emotional.
Well, to your point about it all snowballing on, imagine you didn't get those extra, the savings for 2 deposits.
Yeah.
Or you had that you're paying off piecemeal to the ATO for the next 2 or 3 years, and then suddenly your ability to buy was halved.
But imagine if I never went banging on the doors to find the right broker who gave me the right advice, and then gave me the connection to the right accountant. Who, funnily enough, are still my broker and accountant to this day.
Yeah.
And so, and you can see the portfolio that I've now built to, they are at the level that they have allowed me to get where I am. So I haven't outgrown them, because I'm still acquiring, still building, I'm still being able to do it.
Client at this point, hey? Yeah, with the size of it.
But yeah, man, it's you will outgrow people, and that is completely fine.
Yeah.
And when you realize that that's the case, and that sometimes you have to cut. Sometimes you have to clear, trim the dead wood to grow to the next level. And yeah, man, like that's one of the beautiful things that we get to do, both at Australian Property Scout, School of Property. We get to refer people to our A team and our group of A team. And for clarity, I very proudly say I don't take commissions or kickbacks from anyone. I don't need it, right? I refer to people that I know can do the right job for our clients. And so that's what I love, man. I love being able to refer to those guys that can actually help our clients build to a really, really good level. Because it's paramount, man. Like your team is at least 50% of the journey. You have the incorrect team, if not more, because you'll hit a stop point, right? So I might 50% to start, but then the pendulum starts to swing to 100% because you don't have the right team. You're going to get stuck. So,
that's because your business model, in terms of you wanting your people to succeed, your business model is built on people winning and coming back, win and come back, win and come back.
Yeah.
So, you almost have that incentive for your people, as in your client, to just perform really well.
For sure. 100%, man.
Well.
100%.
Yeah.
I mean, the way I've always looked at it, like, no one will ever see an ad for Australian Property Scout anywhere. Never has been, never will be. And it's because we have such a massive amount of repeat and referred clients, because we have this huge focus on people winning. And so I don't advertise. School of Property is a different thing. Obviously, it's a different arm of the business, all the rest of the sort of thing. But within Australian Property Scout, man, if we can help build people's portfolios and keep building them, and there's a relationship that gets built over time when you're buying properties for people. You work with different people in the business. You might keep the same strategist, obviously, the whole way through, but you work with different buyers agents at different times, acquiring different markets. And what you'll find is, man, or what we found, especially myself, is that over time, what I loved working with was repeat clients. And then, Jim referred Liam, and then Liam referred Phil, and whatever. And then all of a sudden, you're working with this network of people. They all know each other. They all love it. They're all talking about it. They're all happy. And you're working with almost like a group of mates, because you'll get on so well. Rather than working with, this new lead, this one client. Like, I don't like that.
Yeah.
And
in and out. They complain about stuff. They don't know the process. They don't.
Man, I've told the boys on the front end, like, if someone wants to trial us on a deal, they're not the right client for us.
Yeah.
We don't need that. Like, what we want is we want people who want to invest for long term, that want us to help them build a portfolio that allows them to succeed. And man, it's simple, because when that's the case, man, if people really want to work with you, and then we really want to work with them, we create this mad synergy that creates the mad results, and there'll be mad times, and there'll be times where things need to be fixed and taken care of and helped with, because property, man, it's bricks and mortar, it's people. Things go wrong. Let's be honest. It's not a journey that, over 10 years of investing and building a 10, 15, 20 property portfolio, you're going to have something happen.
Yeah, for sure.
It's not all sunshines and rainbows, So, man, it's one of these things we want to work with people who are really committed to that side of things, because we'll really commit to them to get the results as well. And mate, I love this stuff. You know what I mean? Like, dude, I've been doing this for 16 years. I've been running this thing I'm going on 8 years now.
Eighth birthday.
Hey?
Eighth anniversary for
Eighth
APS?
anniversary. Oh, actually, I think we're in our 7th year. I think it's 7 at the start of next year
Yeah.
in January or late this year. So I think January is a proper seventh birthday.
Wow. It's pretty crazy, like grown quick.
It has, man. It has. But I think it's built off that premise.
Yeah.
Because it's twofold. You know what I mean? It's a double whammy both ways.
Yeah.
And man, it's like, if anything, I'm more passionate about what I do now, and I have no need to do it, but I'm more passionate about it now because of what we can I love the staff and what they're able to do as well, and help them achieve what they want to achieve, both from a portfolio and everything else, but then clients, and getting them to positions that I never got helped with and my parents never got helped with as well. So I don't know, man, I just love it. I'm dead passionate about it and I love it, and I don't reckon it'll ever go. So it's sick.
Well, that's fantastic. And we'll still be talking on the 10th anniversary of Australian Property.
We will,
Scout,
mate. We
talking
will.
about how good it's going. But mate, I think that's all we have time for. How long you left in Sydney? How many days left?
Mate, I'm here till, what's today? Today's Tuesday. I'm here till Thursday. So I've still got a couple of days, man.
Well, whirlwind journey as always.
Always, mate,
Back
always.
up to the GC.
Always on the road,
Back up
always
to the
make
new
happen.
pad. Have you moved in?
I have, mate. I have.
Nice.
I moved in. I've got all the packing finished. Actually, funnily enough, the lease on the old place ends today. So I got the final round of. I picked the jet skis up last night. So we went and picked the jet skis up last night, and
Mate,
that's
no rest for the
that's the last
weekend.
thing.
Bloody hell,
mate,
yeah.
work hard, play hard. That's what it's all about.
Yeah, nice. Look, that is all we have time for today. Thank you so much for joining me on the podcast, Sam.
Thanks, Liam. Absolute pleasure, mate.
That was Sam Gordon from Australian Property Scout, and that is all we have time for today. And we'll be back at the same time in just a few days' time on the Smart Property Investment Show. But until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.